we got to touch on the PMI data. And I do want to highlight one thing before I hop into the additional slides that I have on the macro side. Most of the other slides I have on the macro environment are going to sound pretty darn negative. You may start calling me Dr. Doom again. You may say sky is falling. I want to highlight and emphasize the fact that when we look at this chart for both Europe and for North America, manufacturing data still looks quite strong. You can see that in the coloration of the data over on the far right-hand side. Many of the data points within Europe and the United States are in the mid-50s, which is suggestive again of year-over-year growth. And this is year-over-year growth on an already more difficult base. We're no longer comparing to a COVID year, we're comparing to 2021. That being said, got to highlight a couple quick things. One, obviously Russia is having a tough go of it right now. They've softened pretty dramatically for obvious reasons within the manufacturing side. Looking a little higher on the table, kind of top right corner, emerging markets and China have both taken a hit. Emerging markets, I would argue, is because if you take a step back and you think about some of the things that Elizabeth commented on, inflation tends to hit, lower income economies, emerging market economies before it hits the developed economy. So yeah, maybe we're seeing a little bit of a precursor to what we ultimately see in North America and Europe, but it's certainly biting within the emerging markets. And one of those emerging markets is ultimately going to be China, who is additionally experiencing issues with regards to COVID again. Whether we like it or not, China is going through a scenario whereby they've got roughly 70 million citizens on full-on lockdown. So we're talking a big reversion back to basically 2 years ago, where Shanghai, Shenzhen, a couple other large cities are in full lockdown right now. That's impacting, manufacturing activity. Obviously, it's impacting demand on one side. For Elizabeth and the logistics world, it's obviously going to have impacts on the movement of goods out of that country or even into that country. So I would expect a lot of these bottlenecks to rear their head again. The ones that we hoped were behind us, unfortunately, just are not with regards to China. But again, keep in mind, emphasis on North America and Europe is that manufacturing activity, as we see it right now, and I would say even looking forward a quarter or two at least, is looking pretty strong. And many of the conversations I have with customers suggest that even though we are seeing, rampant inflation, most backlogs are still well intact. Not a whole lot of cancellations or anything like that, but we are keeping an eye on that. We've talked about this slide in the past, but ultimately, I'll kind of breeze through it. But ultimately, the idea is commodity markets, whether it's agricultural markets, energy markets, or metals markets, as you can see on the left-hand side, they were roaring, they were soaring for the better part of 2 years, even before Russia invaded Ukraine. Fast forward to where we are now, all of that tightness is now exacerbated. And that's because Russia and Ukraine are very commodity centric. They export a large quantity of those commodities. So anytime there are sanctions or self-imposed restrictions on buying any of that product, it's just further tightening all of these markets. Again, I don't want to belabor the point too much, but anytime those tensions are escalating, you can expect that to be have a positive impact to the price of commodities. And the reverse is also true, that if you saw those tensions de-escalate, you could see the price of commodities head the other way. This one is pretty fresh, but I mentioned I'd talk very briefly about the energy side of things. It is worth noting that in the last week or two, the United States did announce that we are going to release 1 million barrels per day for the next 6 months. So call it 180 million barrels of crude oil is coming out of the Strategic Petroleum Reserve. Now, this is very fluid, very fresh, but over on the right-hand side, the International Energy Administration, the IEA, similarly announced that many of our allies are also going to release stockpiles from their strategic reserves. You can see the actual numbers over on the right-hand side, and I will admit that the United States number is a little bit of double counting. So in reality, we already knew about the US SPR release. So you almost have to take that 60 million out because that's being double counted there. But nonetheless, we're seeing a little bit of an easing in the price of crude oil. And I think we'll see a little bit of an easing as it feeds through to diesel fuel here in the coming weeks, just on the fact that a lot of these releases are at least signaling that the administrations are trying to better supply the markets. Now, I also think that part of the reason why we're seeing energy prices lower is also because China, as I mentioned, is in a pretty stringent lockdown, and that's impacting demand as well. That one is going to be a little more temporary, in my opinion, that if and when they reopen their economy again, whether that happens in a week or a couple months, that demand likely comes back and perhaps even comes back with a lot of accommodation on the financial side. But as we take a step back and look at Europe and the United States, while manufacturing activity still looks pretty good, the part that doesn't look very good is the inflation data. Here in the US, the blue line, you can see that we're seeing some of the most difficult inflation, or the highest inflation that we've seen since the 1970s, the Jimmy Carter era. And if you have any friends, or if there are any European colleagues on the call today, our heart goes out to you, because what we're experiencing here with regards to inflation is about doubly as bad. This is the the producer price index. So this is maybe more of a wholesale type look at inflation. US is running close to 15%. Germany, as shown here in this chart, but it's really all of Europe, is running close to 25 to 30% at this stage. So part of that rationale is because, one, I would argue Europe is just a little less energy secure than what the United States and North America is. And secondarily, maybe the more obvious reason is because geographically, and I've got the map behind me, I'm not going to point it out, but they are located closer from a proximity standpoint to Russia and Ukraine. So a lot of the reliances for commoditized goods, or just things in general, as it relates to Russia and Ukraine, is much more emphasized within Europe. So anything that's biting here in the US is biting much harder within Europe. And with that, I promise I won't be too negative on this one, but over the last week, this has gotten a number of headlines. And this is, I got to give a little bit of color on what we're looking at here. The blue line is looking at the 10-year Treasury yield, and it's comparing it to the 2-year Treasury yield. If we think about what that means is, if you were out buying government debt, normally if you're taking counterparty risk to a government for a longer period of time, normally you would expect to get compensated a higher rate of return to do so. Conversely, you would expect a lower rate of return if you're taking a shorter duration of counterparty risk to the government. So in a normal market, you would expect the spread between the 10-year yield and the 2-year yield to be positive. That's in a normal market environment. As many of you have probably seen, there's been a lot of talk about interest rate increases, which does impact the front end of the curve. In other words, 1-month LIBOR all the way out to 2-year, 5-year interest rates. And even the 30-year mortgage rate is now very quickly, in the last 2 months, it's up about 200 basis points from 3% to about 5%. Now, that's a very lengthy description in saying we watch the yield curve as a potential proxy for how traders and how people are viewing the state of the economy, because there are points in time when the longer term economic prospects maybe don't look as good to the market. The 10-year yield can move below the 2-year yield. We call that an inversion of the yield curve. And you can see that does on occasion happen. And unfortunately, when that happens, it often is viewed as a recession indicator with a fairly decently long lead time. So I'm not saying sky is falling in 2022. I'm not saying, you need to go and sell out of all of your equities and go to cash. Normally, when this happens, historically going back to the 1970s, the inversion of the yield curve has led a technical recession, which is 2 straight quarters of negative GDP growth, by about 15 to 24 months. So again, not at all saying that it has to happen, but if we assume this relationship maintains, we could see a scenario whereby, come 2023, maybe even into 2024, we could start to see some softness in GDP data. And I think as we circle back to everything that Elizabeth talked about and some of the things that I've touched on, there is a growing concern in the market that at some point, if we continue to see inflation ratcheting up and up and up, and the consumer actually gets pinched on their on their own incomes and they have a lesser ability to pay for things, the one way to fix that is to have demand destruction, unfortunately. So again, I think I mentioned this at the onset. We aren't seeing a ton of demand destruction or cancellations of orders at this stage, but I think it's something that certainly we want to have on our horizon. And when you take it into context of this chart, certainly something that we keep an eye on here at Ryerson. I think our customers should as well.